as a business valuation firm is to conclude to a fair and reasonable value that these two parties should be transacting at based on the knowledge that we have and our experience. So from a valuation standpoint, when looking at any business, at the end of the day, it's an asset. And that asset is spitting off cash flow. And that cash flow has a perceived risk associated with achieving it on a year-over-year basis. And so the primary place where we start is collecting financials from the particular party to understand from a financial standpoint all the quantitative figures about the business, going from revenue, digging through each individual expense to arrive at net income and assessing, okay, relative to industry, is this normal? And if it's not, we will inquire further as to, is this a personal expense? Is this a non-recurring expense? Why was this incurred? And once they provide that information, we can then start making adjustments to the financials to arrive at what is seller's discretionary earnings, which really that figure is what is the cash flow available to you as the owner of a business. And then we subtract out a replacement salary for the work that's being performed by that individual in the business. If they're the seller, or if they have someone if they're absentee, or they have someone that is actually managing the day-to-day, we'll adjust SDE to factor in that individual, because most individuals taking over a business are going to be operating that business, and so they won't need certain personnel. So adjustments have to take place in the financials, but we come to seller's discretionary earnings and then EBITDA, which is a mouthful of an acronym, but at the end of the day, it is in reference to the cash flow available to the business. So once we get there, that's pretty much like half of our analysis, is just recreating what cash flow is for the business.